Stochastic Oscillator. The first class of indicators we want to discuss is the stochastic oscillator. Let's talk about what exactly a stochastic oscillator is and how do we interpret it. A stochastic oscillator measures the position of an asset relative to its high and low over a specified period. For example, let's say we're looking at an asset over the last 10 days. Okay? So we look at the high of the last 10 days and we look at the low of the last 10 days and then we look at where is the price now relative to that high and low. And that's what the stochastic oscillator does. It measures where an asset is relative to its high and low over some specified period. And when we calculate the stochastic oscillator, we do it in percentage terms. So if we see the oscillator at 100%, it means that it is at the highest point. Right? So of its high and low range, it's at the highest point. If it's at 0, it means that it's at the lowest point. If it's at 50%, that means it's at the midpoint. And so on. Right? So then you can get this percentage going from 0 to 100, where it tells you where is the price relative to its previous range. That's essentially what the stochastic oscillator does. When we study the stochastic oscillator, you'll often see in technical packages, so for example, this will be the case on Yahoo Finance, you'll see a fast stochastic and a slow stochastic. So these are two different calculations of the stochastic oscillator, and we'll talk about each of those in our lecture, and we'll go through what the differences are and obviously the similarities too. And quite often they are used in combination to form a trading strategy. So the one thing about stochastics is that there are a variety of different trading strategies out there, and we can combine them in lots of ways. The primary use of stochastic oscillators is to measure overbought and oversold conditions. Just like we did with the relative strength index, right? The relative strength index is a value between 0 and 100 that tells you whether something is overbought or oversold. Likewise, the stochastic oscillator is very similar. It's between 0% and 100%, and it also tells us whether something is overbought and oversold. And oscillators in general essentially mean looking at up and down price movements, so that implies looking at oversold or overbought conditions. So the way we interpret the stochastic oscillator is, as a result, fairly similar to the way we interpret the relative strength index. So that should be comforting for us because we've studied that in the last lecture, so we can really apply some of that knowledge going forward into this lecture. So first we'll now discuss the fast stochastic, and we'll go through an example, and then we'll come back and do the slow stochastic after that. Fast stochastic. So now we'll talk about each of the stochastic indicators, the slow stochastic and the fast stochastic. And we'll start with the fast stochastic indicator. Now, I just want to let you know that the fast stochastic is a standalone indicator, so it doesn't have to be used with the slow stochastic. It's not calculated using the slow stochastic. So we can consider this as an indicator on its own. So with the fast stochastic indicator, there are two lines that form it, right? We have the percentage K line and the percentage D line. Now, I don't know exactly where these names of the lines come from. I'm sure there's a good reason for them, but I'm going to use them because that's conventionally what is used for the fast stochastic. We have the percentage K line that measures the asset's price relative to its highs and lows over a specified period. Okay, so if we take a look at the formula, we can see the percentage K, and the numerator is the current price minus the minimum of the price T to price T minus N. What that means is that we're looking at the minimum price over the last N days, right? So PT up to PT minus N is all the prices between today's price and the price N days ago. So that's what that means, and the min means just the low of those. So that's on the numerator. On the denominator, we have the max of the price over the last N days, which is the first term, which is the high, and we have again the minimum of the price over the last N days, which is the low. So we can see how this indicator would tell us the asset's price relative to its highs and lows. Following on from the percentage K line, we have the percentage D line. The percentage D line is fairly straightforward. It is just a simple moving average of the percentage K line. So we take the M-day simple moving average of the percentage K line, and that gives us the percentage D line. So now these two lines together create the fast stochastic indicator. So as we said, there are a number of trading strategies we can do with the fast stochastic indicator. I'll just tell you one now, or a couple now. So one trading strategy is to buy when the percentage K line crosses above the percentage D line. Remember that the percentage D line is a moving average of the percentage K line. So we buy when the percentage K line crosses above the percentage D line, and we sell when the percentage K line crosses below the percentage D line. And this is really similar to a moving average crossover strategy. Okay? So it's exactly the same, except we're using these two lines, the percentage K and the percentage D line. So that's one trading strategy. Another one is like the relative strength index strategy. So we could buy if either line is below 20, that would be an oversold condition, and we could sell if either line is above 80. That would be an overbought condition. So that's just a couple of examples, and when we go through in detail, we'll actually see it in Excel. Fast stochastic. Here we are now in Yahoo Finance, and by now I think this should be a familiar chart to all of us. This is again the Nifty index from July 2011 until July 2012, and what we are going to do is show you the fast stochastic on Yahoo Finance. We'll plot the indicator so that we can see what it looks like. So I need to just go to technical indicators here. You can see my cursor. Go into fast stochastic. So you can see both fast and slow stochastic here. And now it's giving me the percentage K period and the percentage D period. Now we're going to go with the defaults, which are 5 and 3. So the 5 percentage K period means that we're looking at the highs and lows over the last 5 days in order to draw the percentage K line. And the percentage D period is the moving average of the percentage K line. So in this case, we're going to use the 3-day moving average of the percentage K line. And what it means by fast stochastic, it means that these days are very short, right? So when we do slow stochastic, we'll be using longer time periods. So I'll click draw now. Alright, and now if I go down here, you'll see these two lines which comprise the percentage K and the percentage D line, the fast stochastic. The blue line is the percentage K line and the red line is the percentage D line. So as we said, there are a couple of different trading strategies you could do. One would be to buy on crosses. So whenever the blue line is above the red line, we should be long. And whenever the red line is below the blue line, we should be short. It's a little bit hard to tell from the chart how that would do, given that these lines pretty much seem to move very, very closely together. Because one is just a 3-day moving average of the other, they move very, very, very close together. And in fact, because this is a 1-year chart, we're using a very short moving average on a 1-year chart, so it's very hard to see their differences. But if this was a shorter term chart, then it may be more clear. So for example, if I did a 1-month chart, okay, now you would see the gap between the fast and the slow stochastic a bit more clearly. I'll just go back to the 1 year. But let's now look at this. So one is that crossover strategy we could do. Another, of course, is to buy when it's overbought or oversold. So when these lines are near 20, these would be buy signals. And when they're at this level around the 80, these would be sell signals. Alright, so you can kind of see for yourself. It looks very similar to the RSI in terms of how it would perform. Again, as an oscillator tends to do best when markets are not trending. So what we're going to do now is instead of focusing on the chart, we'll actually go into Excel and we'll calculate it in Excel so that we know how it works. And then we'll do the position calculations as we've done previously, sort of calculating where and when you would take a long or short position based on the different trading strategies. So let's go ahead and do that now. Fast stochastic. So now what we are going to do is we are going to calculate the value of the fast stochastic in Excel. And now here we are in Excel, and we have a similar data set to what we saw in the previous lecture, except this time we have quite a bit more information. So this data set is again the Nifty index between 2005 to 2011. However, this time instead of just having the closing prices, we have the open, high, low, and close. And this is because we need to use the high and low in order to calculate the value of the stochastics. Okay, so let's go to the fast stochastic tab here. And again, we have the Nifty index. This is the open, the high, the low, and the close. So we're going to calculate both the percentage K line and the percentage D line. Alright, and then we'll look at the trading strategies that come out of that. So we'll do something similar to what we did in the previous lectures, whereby we'll calculate the value of the positions. That is, what position do we take, long or short, based on the different trading strategies. Okay, so first I'll start with the percentage K line, and then I'll do the percentage D line. So let's think back to the formula for the fast stochastic. The fast stochastic is equal to the current price minus the minimum of the price over the last n days divided by the maximum price over the last n days minus the minimum price over the last n days. Now when we saw it in Yahoo Finance, we used a value of 5 days. So we'll do the same thing here. That is the convention, to use 5 days for the percentage K and 3 days for the percentage D. That's for a fast stochastic. So my formula will be the current price, which is, I'm going to say that's the closing price, right, at the end of each day, minus the minimum of the price over the last 5 days. So that's going to be the minimum of, and we're going to use the lows, right, because the lows are the lowest prices. Okay. And that's the numerator of the equation. The denominator will be the maximum of the price over those days, which will be this time the maximum of the highs, because the highs are the highest, minus the minimum of those days, which will be from the lows. And this gives us our percentage K value. Alright, and I'm going to convert this into a percent. Then I'll copy this all the way down, and this is now my percentage K line. So you can see it fluctuates, is close to 0 here, and then here it's closer to 100, right? So it does move around quite a fair bit. The next thing we'll do after calculating the percentage K line is the percentage D line. The percentage D line is just a 3-day moving average. We're going to use 3 days like we did in, like we saw in Yahoo Finance. It's a 3-day moving average of the percentage K line. So this will just be equal to the average of, starting there, down 3 days. So again, very simple moving average is easy to calculate. We'll go down. We'll obviously have to, these 2 days won't be valid because, these days because of that. And even these days because it's going all the way down. So we really need to start up here before we can have this as valid. But this is how we calculate the percentage K lines and the percentage D lines. So as you can see, it's not too complicated, right? The formula for the stochastic oscillator is fairly simple and fairly straightforward. Now what we are going to do is we are going to implement the trading strategy that we talked about on the PowerPoint slide earlier. One strategy is the moving average crossover type of strategy. So when the percentage K line is above the percentage D line, that's going to be a long, and when the percentage K is below the percentage D, that's going to be a short position. That's one type of strategy. Then the other type of strategy will be if either one is below 20%, it's a buy, and if either one is above 80%, it's a sell. So 2 different trading strategies we can look at. So let's just go about and see how would we implement either of those. Okay. So let's start with the, I'm going to call the first one the moving average crossover strategy for this fast stochastic, so MACFS, because that's the similar type of strategy it is. And in this case, what we're going to do is we're going to say that if, alright, the percentage K line, and remember we have to use the previous day's value to come up with the position for that day. If the percentage K line is greater than the percentage D line, then I would like a long position. If it is not the case, I would like a short position. And in this case, every position is long or short, right? Because it's just whether it's above or below. And now you can see the multiple of long positions and short positions we have. So now you know how to calculate this particular trading strategy using the percentage K line and the percentage D line. Alright, the next one we can do is the other strategy whereby we're looking at if either one of them falls below 20%, then it's a buy. And if either one of them is above 80%, it's a sell. So that's kind of our relative strength index type of strategy. So let's just name that RSI fast stochastic. I know these are not necessarily the best names, but as long as we understand what it means, then that's fine. So what we're going to do is we're going to say that, as we said, if either or is below 20, it's a buy. If either or is above 80, it's a sell. And the way we're going to have to do this in Excel is to have two different columns. So the first I'm going to say, so let's just call this part A, and then there'll be part B. Okay, and then there'll be the actual position. Alright, which we're going to calculate using part A and part B. Sorry, that should be a B. So what we're going to say, in this case, we'll look at the percentage D line. So if the percentage K line is below 20, then give me a long position, otherwise give me nothing. So this will actually just be the long positions. Okay? Sorry, that should be 20%, otherwise we get all ones. Yep, there we go. Now we got some zeros in there. And so this is going to be the, so let me change these names actually to make it simpler. So the percentage K longs. Okay? Then we're going to have the percentage D longs. And this is going to be the same formula as that one, except of course it'll be that formula. Yep, so that's pretty much exactly the same. And as you can see, now we have some longs and shorts. And then the overall long position will be, if either of these are 1, then it's a long position. So the easiest way to do it is to just say, is to just add the two. Okay. So every time we get a positive number, so be it 2 or 1, then that means it's a long position. If we get a 0, that means it's a short position. Now I can just change that here by saying, taking that, let's say, divided by 2, and that will be a 1. That's not probably the best way to do it. The better way to do it would be saying that if this number is greater than 0, then give it a 1, otherwise give it a 0. Then now we'll see all the long positions are labeled as 1 or 0. To do the short positions, we follow a similar process. So it's going to be percentage K short, percentage D short, and then two positions for the two columns for the short positions. Okay, so percentage D short will be this time if the percentage K line, is less, is greater than 80%, then I would like a -1, otherwise give me nothing. Now you'll see some shorts, and this will be the same formula over here. That's fine. Then I can copy this formula across to here, and then I can do the same with this formula over here, except I need to change it to if it is less than 0, because now these are all negative numbers, and then I want a -1 instead. So now I have -1s here. So these two columns, this long here and that short over there, so let me call that long A, so we distinguish it. It's not the actual position column. These two columns here give us our long or short positions for this strategy. So it does require a few more columns. It may be slightly more computationally intensive, but it's not particularly difficult. All right, let's now go on, and we'll talk about the slow stochastic. Slow stochastic. So now we've talked about the fast stochastic. The next indicator we'll talk about is the slow stochastic. The slow stochastic is actually very, very similar to the fast stochastic. We can calculate it in one of two ways. So one way to do, which is the way that Yahoo Finance does it, is to just use different parameters. So we use a longer number of days. So in case, instead of using, say, 5 days and 3 days, we could use 15 days or 20 days. And there is a default, which we'll see when we go into the web. So we just used a longer number of days for the percentage K and percentage D lines. So the only real difference is that it's a longer number of days versus the fast stochastic. Another method that's often used is that the percentage D line is used from the fast stochastic. So remember, that was the simple moving average of the percentage K line. That percentage D line becomes the percentage K line of the slow stochastic. And then we then calculate the percentage D line as a moving average of that percentage K line. Right? So it's really just a couple of different ways to calculate it. I think the easiest way is to just use different parameters, right? Just change the number of days. Otherwise, there's actually no difference in calculation of the fast stochastic and the slow stochastic. They're actually just the parameters, the only thing that's different. So you might wonder, well, why are we talking about them as two separate indicators when actually they're calculated in the same way? It's like, what is the difference? Why do we need to have a separate indicator if we're doing a 5-day average or a 20-day moving average? They're conceptually the same, just longer days. Well, the reason we do it is because in a lot of technical analysis software like Yahoo Finance, they often come up as separate indicators, and usually because they have a default days attached to them. So that's why we want to go through them separately. But otherwise, there's really no need to treat them any differently. The trading strategies we'd associate with the slow stochastic are actually the same as the ones for the fast stochastic, right? So like a moving average crossover strategy or a buy at 20 and sell at 80 kind of strategy, either one would be good as a trading strategy for the fast stochastic. Now, as it is a slower average, it does tend to give fewer false signals, right? So as compared with the fast stochastic, because it's less volatile, it gives us fewer false signals. So that's the plus of it. And but it can be slower in identifying new trends and new movements. Obviously, it doesn't respond to new prices as quickly, so it's a bit slower in that sense. So it's just like the difference between using a fast or slow moving average. And again, sometimes you can create trading rules using both the fast and the slow stochastic. So you could do a crossover rule with the fast and slow stochastic, for example. That's one way to do it. One other thing that you can do with stochastics is that we often look at the divergence of the movement between the stochastic and the price. So if the stochastics are going up but the price is going in another direction, that may be a sign that a trend is weakening and is likely to end or reverse. So usually we should see the stochastic move in the same direction as the price. When they move in opposite directions, we can take that as a sign that the trend may be ending or reversing. Let's now go ahead and take a look at this in Yahoo Finance, and after that we'll go into Excel. Slow stochastic. Here we are now back in Yahoo Finance, and what we are going to do is plot the slow stochastic. I'm going to leave the fast stochastic up here as well at the same time, so you can actually compare them and see how they differ. So I guess go to slow stochastic, and you can see the default periods they use now are 15 and 5. 15 is the percentage K line, which tells you that it's looking at the highs and lows over the last 15 days, the maximum and minimum price over 15 days. And the percentage D line is the 5-day moving average of the percentage K line. Alright, so I'm going to draw that. And now you see the fast and the slow stochastic. So if you look at the slow stochastic, you'll see that it kind of has the same general direction as the fast stochastic. Alright, but it's less volatile. It's a lot smoother, alright? So this fast stochastic has a lot more up and down movements, whereas the slow stochastic doesn't have nearly as many. And at the same time, there seems to be greater divergences between the blue and the red line as compared with the fast stochastic. So with the fast stochastic, the blue and the red line tend to be very, very close together. In the slow stochastic, they're slightly further apart. They still do move fairly close together. So it's not the case that it's completely divergent, but nonetheless you can see that there's a very clear difference between the fast stochastic and the slow stochastic. So the other thing that we mentioned in the previous slide was that in addition to those two strategies, one is kind of the moving average crossover strategy, and the other is looking at when it's low, when it's very low or very high. The other thing you can look for is when there's a divergence between the slow stochastic or the fast stochastic and the underlying price. So when there is a divergence, that is often a sign of an end of a trend, and when it moves together, that's often a good sign. So, I mean, I guess it is not, if we look for some instances where there may be divergences, we can kind of see over here that the stochastic's rising and the prices are kind of holding steady. And here the prices are falling, the stochastics are falling at the same time. Here they're rising together, and here they're falling together as well. So it actually does tend to move, in this example, in fairly close lockstep. So we can't really find any situation whereby they have a significant divergence. I would say that, for example, up here, you will see that the slow stochastic is and the fast stochastic both are giving you heavily overbought indicators telling you to sell, but actually the price keeps going up. So this is the example of how if it's in a trending movement, the oscillator is not very useful. And that's again the case with a lot of different momentum indicators. Okay, let's now go on to Excel and we'll do the calculation of the stochastic. Slow stochastic. Here we are back in Excel, and we're continuing where we left off here on this fast stochastic tab. And again, I apologize for this long-windedness of this strategy, but unfortunately this is the easiest way to show it step by step, how to calculate it. So what we're going to do now is go into the slow stochastic tab. It's the same data, again, open, high, low, and close. And the calculation should be easy for us to do because it's going to be a very similar calculation that we did before, except we're using different parameters. So first we'll have the percentage K line and the percentage D line. So in this case, we'll use the parameters of 5 and 15. So sorry, for the percentage K line, it will be 15, and for the percentage D line, it will be 5. Those will be our parameters that we're going to use in order to calculate it. So let's just recall the formula. The value of the percentage K line in the numerator, we're going to have the current price, okay? Then we're going to subtract the minimum of the lows over the last, this time it'll be 15 days, so it'll go from 2 until 16. Okay? Sorry, so that's not the whole thing. Then we have to divide it by the maximum of the price over that days. So that'll be max of that minus the minimum of the price over those days. That'll be the same value there. I'll just put brackets around that. Copy this all the way down, make it into a percent, and now we have our slow stochastic, percentage K line. The percentage D line will be a moving average, a 5-day moving average of the percentage K line. So that's a fairly simple one to do. Average of 1, 2, 3, 4, 5 days. And that becomes my percentage D line and my percentage K line. So we're not going to go through the trading strategies again because they're the same as we did for the fast stochastic in terms of how they're calculated. What I would like to do is actually look at the fast stochastic and the slow stochastic and compare them. So I'm just going to go over to the fast stochastic tab. I'm going to copy these percentage K and percentage D lines across to the slow stochastic tab. Okay, we have to paste it as values. Okay, so there we go. That's the percentage K and percentage D. So let me just label these. So this will be the percentage K of the fast stochastic and the percentage D of the fast stochastic. So now if we look at some of these numbers, so I just want you to look at the percentage K line here. You can see how smooth this is, right? This is 25, 30, 34, 39, 44. It kind of moves not that quickly. And you can look at the fast stochastic and just look how fast it moves. The fast stochastic goes 8, 4.5, then 43, then 74. So you can really see that the fast stochastic tends to move a lot more quickly than the slow stochastic. And this is really what we saw on the chart as well. We saw that the fast stochastic was very, very volatile. So as we said, you can create individual strategies using the fast and slow stochastic. You can combine them to create a strategy. So we could, for example, have a strategy whereby we just use the two percentage K lines. So I could say, for example, so let's say I wanted a trading strategy with the fast stochastic and slow stochastic crossover. Okay. Then I could, for example, say, well, if the fast stochastic is greater than the slow stochastic, sorry, we should be the lower one here. If the fast stochastic is greater than the slow stochastic, then I want a long position, otherwise I want a short position. And that's one way we can do this trading strategy. So let me just see why this is not working. If H3 is greater than F3, yeah, there should be a bracket there. Alright, and here we go. Now we see there's a bunch of long and short positions. And you can do that with the percentage D lines if you wanted. You could say if this line is greater than that, if that line, then give me a long, otherwise give me a short. So as you can see, there are a multitude of ways in which we can actually calculate and do trading strategies with the slow stochastic. So the one thing that is common, it is actually fairly common to combine the two. So in addition to just using strategies with only the fast stochastic and the slow stochastic, we can calculate them. And just some final thoughts about the stochastic oscillator. It is a momentum indicator, so it does tend to work best when markets are not trending, right? Just like the RSI indicator, it tends to be a good indicator when there is sideways movement, or there is mild trends, or there are trends ending or trends reversing. The stochastic oscillator does a fairly good job of identifying these instances, and as a result, it's a very good indicator because it works quite well. It's fairly simple to calculate, so it is used a lot in practice. That's why you will find it on Yahoo Finance and most technical packages will tend to have the stochastic oscillator on it. So that now concludes our discussion on the stochastic oscillators. So we've talked about the fast stochastic and the slow stochastic. The next thing we're going to go on to talk about is the stochastic RSI, which is something quite different. So let's go on and do that.